Okay, you guys, we're now going to look at Chapter 12, which deals with investments. Now, how a corporation accounts for investments would depend on how the investments are classified. The accounting treatment is different for different categories of investments. And first, I thought we'd look at some different types of investments. A corporation or a business could invest in common stock or preferred stock of another business. They could also buy corporate bonds of another corporation, or they could loan out money. Now, all of those would be investments. So, for instance, Coca-Cola could own common stock or preferred stock of Microsoft, or Coca-Cola could buy the bonds of Microsoft. Or Coca-Cola could just make a loan to an individual or to another business if they'd like. Now, the objective there, and those could be purchased by individual investors, mutual funds, or corporations. The objective is for the investor to earn a return from the dividends, which they'd receive on common stock or preferred stock possibly, or interest on the debt securities. Or they could experience an increase in the market price of the common stock or preferred stock or the bonds that are publicly traded. Okay, and there'd also be a market for selling notes receivable as well. So let's look at the different categories and how they're treated here. And the objective in investing could also be to develop ongoing affiliations with the companies whose securities are acquired. For instance, Coca-Cola might buy some of the common stock of one of their suppliers, just as kind of a nice thing to do. Walmart might buy some stock in Procter & Gamble, just because Procter & Gamble is one of their big suppliers. So they might buy some stock just as a way of maintaining a good relationship with that company. But mainly, corporations are purchasing investments to earn dividends or interest or experience increases in market prices. Okay. Now you can also find this chart in your book. It's back in the beginning of the chapter. But it goes through some different types of investments. Control characteristics of the investment. If the investor lacks significant influence over the operating and financial policies of the investee, the company they're investing in, then investments in debt securities, which would be notes receivable or bonds, for which the investor has the positive intent and ability to hold to maturity. So let's say we're dealing with 10-year bonds and the investor buys them. They plan on holding them. They have the intent and ability to hold those bonds for the full 10-year term. Or if they loan someone money, they have the intent and ability to hold that note receivable for the full, let's say it was a 5-year note. Those are called held to maturity investments, and they're reported at their amortized cost, which we'll get into more later on. Investments held in an active trading account where the investor lacks significant influence over the operating and financial policies of the company are classified as trading securities. And trading securities are reported at their fair value, which is a break from, it's different than recording investments at cost. We traditionally record them at cost. This was a change quite a while back now, but the trading securities are reported at their fair value, even though they haven't been sold yet at the end of the year. Now, these unrealized holding gains and losses on trading securities are actually included as a part of net income. Our other category would be securities available for sale, and an investment, and those would be reported at their fair value as well, with unrealized holding gains and losses not included in net income, but instead they would be reported as part of other comprehensive income. Okay, if the investor does have significant influence over the operating and financial policies of the investee, that would mean they typically own 20 to 50% of the voting stock of the investee. Now, these would be equity securities, of course. Then the equity method is used. The investment is cost adjusted for subsequent earnings of the investee and dividends of the investee. Now, if the investor controls more than 50%, then we would prepare what's called consolidated financial statements, where the investor would bring the investee's financial statements into their financial statements, and it would be reported as if they were a single company. We're going to go through all three types: held to maturity, trading securities, how they're handled journal entry wise, and available for sale securities. And then we're also going to look at the equity method of accounting for investments if the investor has significant influence over the operating and financial policies of the investee. Okay, I don't know that this is anything. I know I want to look at that chart. Here we go. All right. Accounting for unrealized holding gains and losses when the investor lacks significant influence. This chart can be used on those first three we looked at. If you have held to maturity securities, those are debt securities, and again, the investor plans to hold those for their full term. Unrealized holding gains or losses. Unrealized just means we haven't sold them yet. So they've gone up or down in value, but they haven't been sold. Well, if it's a held to maturity security, we're not going to recognize any unrealized gain or loss. And we'd report those investments at their amortized cost. We're going to look at bonds a little bit in this chapter. We'll get into them a lot more a little bit later in the course. But bonds are your held to maturity securities. Our trading securities for debt or equity that's held in an active trading account for immediate resale. If they go up or down in value, then we are going to report those unrealized holding gains or losses as a part of net income, and therefore a part of retained earnings and shareholders' equity. And on the that'd be on the income statement. Then on the balance sheet, we're going to report them instead of at cost, at their fair value at the end of the year. Now, available for sale securities are handled the same way, except the unrealized holding gains and losses are not a part of net income. Rather, they're a part of other comprehensive income. And therefore, they're accumulated in other comprehensive income in shareholders' equity. They're reported just like trading securities on the balance sheet at their fair value. So this chart and this chart should probably be the most help in going through the exercises, and you can find those back in your in the beginning of your chapter. All right, so now we'll start taking a look at some of them, and if you have questions, please be in touch with me. But go over this chart and this one quite a bit, and we're going to refer back to them in working the exercises as we go along. Okay, thanks.